There is a cost to sitting on the sidelines. There's a cost of not taking action. The shift happens when you decide to stop doing everything yourself and to start doing things with other people. We got to be prepared for a Trump administration. We got to be prepared for a Harris administration. We got to be prepared for inflation to continue. We got to be prepared for inflation to stop. We got to be prepared for the Fed to cut rates. Where I've seen people fall short is people love to do communications or over communicate when things are going well. And when things are going less than well, they're hesitant. It occurs to me that we are at or near, the bottom of a market cycle. Well, I think there's going to be some distress because one of the biggest reasons for failure in times of adversity is when the GP teams are not aligned and they're pointing fingers at each other and blaming each other for what's going on. So like what I always tell people is,
how does it feel, man, to help so many people?
Well, look, there's a saying that I don't agree with, by the way. And there's a saying in the industry that says, like, those that don't do, teach. And it's like, I couldn't further agree because, how I got started was I had a sense that I was doing everything right, studying hard, got good grades, go to college, got a second degree. But after losing my job twice, like how I got started is I read Rich Dad, Poor Dad. So here's a guy like Robert Kiyosaki that dedicated a large percentage of his life to, impart knowledge to other people, because that was a way to reach more people, was by writing books and doing seminars. And that's how I got started, was by reading his books. And then I didn't go to his seminar, but I went to somebody else's. And so if it wasn't for like the generosity of these people that are committed to imparting their knowledge to other people, like I still might be like, on my fifth degree and my seventh job and struggling to climb my way up the corporate ladder after all these years. So, I love the decision I made to not only invest in deals, and I still invest in a lot of deals, and I've made a lot of money. I've helped people that way too, by the way. I have a lot of investors, and we've helped our residents have a better quality of life and a better place to call home. But what really excites me is the results that my students have had. They've come into events that I conduct and the systems that I teach, and they've had, for the most part, like amazing results. And that fulfills me a lot.
Brad, we've been in a little bit of a challenging market over the last couple of years, obviously, with, interest rates just skyrocketing and even inflation really making it really hard for the value add and all these opportunities. How are you adopting your investment strategy, not only to just survive these last couple of years, but actually thrive?
Well, look, it's, I think there's this resiliency and persistency and resiliency factor. And that's one of the advantages of being in the industry for so long. And, what I mean by that is I started in 2002 and had 6 years under my belt before 2008 financial crisis hit. And fortunately, I, had a lot of success in those 6 years. So I was able to withstand the downturn, and there were some deals that I had to put money into. But we got through them. So I have that perspective of having a financial crisis. And, what happened back then is a little different than what's happened in the last few years. But then to say from 2012 to 2022, we had a decade of, prosperity in multifamily. And I'm not saying it wasn't challenging and it didn't take work, because it did. There's always challenges and it always takes work. But for the most part, people that got into the business during that period of 10 years, had a lot of success with deals that outperformed. And a lot of it was because of their effort, but a lot of it was just because of the market, and the tailwinds that were happening. And then we came into another cycle, and we could debate about the causes. And was it the pandemic? And was it printing $5 trillion of money? And what happened? But the bottom line is we came into a cycle where it became difficult again for, to do a bunch of things in multifamily. And one was the deals that we already owned. There were rising costs, and for people that were in variable rate loans, rising interest rates. But it was more than that. We got into deals where we would budget, $1,800 to do an upgrade of the appliance package, and now it's $3,200. So there were a lot of factors at play there with inflation and rising interest rates, but also rising taxes and rising insurance, a lot of markets. And so there was almost like this like negative perfect storm for a period of time that I believe now we're coming out through the other side. And I could say that because like I've been through seasons before, like in 2008 and now, and I don't have a crystal ball, but by looking backwards, we're better able to predict what happens next. And so look, it's, I'm in 37 syndications right now. And the vast majority, by the way, are doing well, but there's a few that have had challenges, and we've put money in those deals. So like what I always tell people is, you do your projections based on the best available data that we have. And we try to use historical numbers in terms of rent growth and cap rates and all that type of stuff. But you always got to have, liquidity. The banks require that when you get a loan, the banks require you to have liquidity. But this is why I never subscribed to like some, really popular people have said like cash is trash and you should live as if you're broke and have all your money reinvested into deals. And like, let me just say, if I had done that in 2008, I would have had a few deals that went back to the bank. And if I had done that in 2022, meaning like I took all my liquid assets and invest them into properties that are illiquid investments, I probably would have had to turn in 3 or 4 properties to the bank. So it's always a good idea to keep, liquidity on the side. And so Mauricio, like, I know you cover this from a legal perspective, but when I approach my mentorship business and my own deals for that matter, it's like, I want to make sure that I'm in alignment with the general partnership team and the loan guarantor team on like how we're going to handle a potential downturn. And that's always a discussion that people should be having. It's just that, the reality is there was a period of a decade where for the most part, like there wasn't a whole lot of that happening.
Because I know you talk a lot about having a rainy day fund, which I think is which I wish more people would do that. Do you have like a set formula, or is it just based on your current cash position?
Like to me, I probably do, but I can't like just accurately represent what it is now. But like, so if I were to create that, it would be like, okay, like how many deals am I in general, LP, GP, there's 3 categories. You're LP, a passive investor. And as a passive investor, you're never obliged to contribute more capital or do loans, although you may be asked to do so. So that's one category. And then there's deals where I'm a general partnership in. And then in some of the deals as a GP, I'm actually not a loan guarantor. And most of the deals as a GP, I am a loan guarantor. So like I would look at that and say, okay, like what's my exposure? And like, so what I've been doing religiously, like every quarter, is I've been inventorying my properties and having meetings with the other GPs and saying, okay, like what forecast do we have a need for extra capital over the next 12 months?
Yeah.
Right.
Yep.
And so like in hindsight, like I've always had, more than enough liquidity set on the side where like, I think if you have all of your money tied up in illiquid assets, that there's a risk that if there's a rainy day, and a rainy day could be, a pandemic, a black swan event, a world war, like a regional conflict, a government instability,
or just your insurance premiums going through the roof.
Your insurance premium goes up. Yeah. So like, look, within the deal itself, let's clarify this. Like every entity, like we own, 300 units and we got 4 GPs, like we should keep working capital in that account. And that's why, by the way, a lot of deals are still cash flowing from operations, but the GP teams have suspended making cash distributions is because it's responsible. It's responsible for us that even though we're generating cash from, operations, because of things that have happened with rising taxes or insurance, we don't want to distribute the money and then have to call for capital. Okay, so there's a lot of deals that are performing really well if you just look at the numbers, but the investors might be like, hey, I don't feel like it's doing that well because like, where's my 8% cash flow, right? So there's that level of liquidity. And then there's the level of liquidity beyond that would say, hey, like, what's your net worth? What's your exposure? You know, how many deals are you exposed in? And so like for me, you know, with a net worth in the, you know, tens of millions of dollars with a lot of exposure, I kept, you know, I've kept multiple seven figures liquid, honestly. And I'm glad I did. No, I don't mean to use those numbers to brag or impress anybody, but look, I've been doing this for 22 years and have had, you know, a degree of success, not like a Grant Cardone level of success or a Tony Robbins level of success, but a level of success that I'm proud of, that I've also been privileged in a position to mentor and help and coach a lot of other people.
Can you talk a little about, since I'm going to ask for you to give some free mentoring advice here, because one of the things that a lot of LPs are generally pissed at GPs from what I've been, as I attend, you know, conferences and stuff. One of the things that they're really upset about is this concept where a lot of GPs are sticking their head in the sand and not communicating with their LPs. And I think that's creating even more, you know, distrust between the LPs and the GPs. You want to talk a little bit about that? Like, how often do you recommend your students, like, should they be, especially when things aren't going well? That's really what I'm focused on. When things don't go well, what do you recommend your students do in terms of communication? How often, the frequency, and all that stuff?
Where I've seen people fall short is people love to do communications or over communicate when things are going well. And when things are going less than well, they're hesitant. And you know, and there's a reason for that. And I'm not saying it's justifiable. There's no good reason to be hesitant. But, you know, investors could get upset. People could go off on them on social media. People were afraid of, you know, not being liked or accepted. They're afraid that like, hey, this is going to hurt my next deal. And I'm not saying there's an excuse for that. Like, my personal opinion and belief is you should address what's happening head on, but it should always be like, hey, here's what happened. You know, here's why we think it happened, you know, and here's what we're doing about it. And so to provide that transparency of like, here's what I know, here's what happened, and here's our plan. I think investors like to see that, even if it's not always good news. Like, I think investors like to see that, you know, GPs have a handle on things, and they should never promise that like, hey, everything's going to be perfect and fine, but to say, hey, acknowledge what happened, address what happened, and put your plan and put your communication, like, here's what we plan to do.
Yeah, you know, our good friend Ken McElroy always likes to say, you know, communication builds trust, which I think is true, especially when things aren't going well. He always talks about doubling or tripling down your communication. Well, let's put aside the sort of the issues that we've been having over the last couple of years. Let's talk about some of the opportunities. I know you've talked about the opportunity that multifamily specifically presents itself. Are we there yet, Brad, or are we still need to get through a couple of more months or cycles, or is this the time to start jumping in, because it's been 2 years already?
Well, look, you know, it occurs to me that we are at or near, you know, the bottom of a market cycle. If we look at a clock, like a circle, where 12 o'clock is the top of the market and 6 o'clock is the bottom of the market, like just from a lot of things that I noticed, like, you know, inflation slowing down, and the Fed shift on talking about cutting rates, and, you know, some weakness in the job market, and what's happening with manufacturing slowing down, and, you know, the supply of multifamily that peaked, and now, you know, there's less new inventory coming on, and there's positive rent growth again, and there's billions of dollars of dry powder on the sidelines. And then you see like the big companies that are stacked with Ivy League MBAs, and like, you know, the BlackRocks and the Starwoods and the KKRs, and they're all jumping into the tunes of billions of dollars. Like, it occurs to me that we're at or near the bottom. Like, and I can't prove it, and I could be wrong. And there's a lot of things that could happen. Like, people need to understand that there's always risk in any business venture. And there's an election coming up, and there's a possibility of more conflict with, Ukraine and Russia and the Middle East. And there's a lot of things that could upset the status quo. But what occurs to me is that we're near the bottom of a cycle. And once the election happens, either way, the capital markets and Wall Street are going to know what we're dealing with for 4 years. Like right now, we don't know what we're dealing with. We could start baking it in. We could say, hey, Kamala wants to do this. Trump wants to do this. And so they could start anticipating, like, we got pretty much two options on how things are going to go down with their stated policies. And there's still some clarification around that. But I just think that once we pass through November, unless there's a black swan event, that we're going to have 4 years of stability and certainty, and we're going to see an uptick. And so, we're near the bottom of a cycle in my book.
Let's talk about scaling a little bit, Brad. A lot of folks who get started in this business, they're starting off in single family and sort of smaller multifamily. And they sometimes struggle to make that jump to the larger syndications. So talk a little bit about some of the steps and maybe the mindset that someone needs to have in order to make that jump from, single family, duplexes, fourplexes, all the way to bigger apartment buildings and raising capital.
Well, look, I think that it is a mindset thing, because the shift happens when you decide to stop doing everything yourself and to start doing things with other people. Okay, so you can only, all of us here, no matter how much we have, we can only do so much on our own. And I'm not just talking about money. So just think about it. We all have limitations on time, resources, resourcefulness, money, experience, and skills. And so, you could have all the money in the world, but if you don't have the ability to source deals and underwrite deals and, have a broker network, like, you may not be able to place that money. So it takes time, energy, skills, and whatever. And so in the beginning, the first decade I did this, I tried to do everything myself. I bought deals with my own money until I ran out. And then I syndicated deals, but I was the only GP until 2012, even until 2014. I would just try to GP everything myself. And that means I'm the only active investor. I'm finding the deals. I'm underwriting the deals. I'm going to broker networking events to source deals. I'm crunching the numbers. I'm doing the due diligence. I'm raising the equity. I'm going through all the things needed to close the deal, the due diligence, the management agreement, the syndication, all of those things. And it's a lot of time and energy. So I'm doing a deal a year, a deal every 2 years. And I couldn't scale. And so only when I decided to say, hey, let's have co-GPs where we divvy up the workload, Mauricio, where all of us have substantive duties, but we divvy it up in a way that allows us to contribute to things that we're best at. That's allowed me to scale massively. Now, is there more risk in that? Well, there is inherently, because if I got 4 GPs as opposed to the only GP, now I got 4 people that are making substantive decisions and are doing substantive duties. So now it's not just about the property and location, it's about the GP team and having alignment, which adds another layer of complexity. But if you can handle that and you're up for it, and you could get those, have consensus and alignment within your GP teams from the get-go, it's the way to go. It's the way to scale. And I'm just telling you, it's the best way I know to scale the business and not have to do everything yourself. Now, some people are going to scale the business the old-fashioned way, which is do everything yourself and be vertically integrated and do your own construction and rehab and property management and everything. And then they start a fund, and it's and that's another way to go. But just to be clear, that takes a lot of time, energy, commitment, and money. So the way I've helped people scale the most is by embracing this, let's collaborate together and do deals together with LPs and GPs. Does that make sense? Does that answer your question?
Not only did you answer it, I love it, but you rattled off so many substantial duties that I'm going to have to go back and list them, because I'm always trying to communicate all the substantial duties that GPs need to make, right, to do. And you just rattled off 100 of them. So I'm going to steal some of that. So I appreciate that.
Yeah, well, that's people need to know that. And I missed a few, investor relations and communication and reviewing financials. But imagine doing all of that yourself. even if you had the money, like nobody has the time and the skills, and we're not good at everything.
Yep. No, 100%. Speaking of mindset, it's a good transition because you've got your national convention coming up at the end of September, the last weekend of September. And I'm looking at your website and you talk about the 6-step millionaire mindset. I know you're going to be talking about that at the conference. Can you go through the six? I don't know if I can help you with it, but what are the six steps?
So, yeah. So look, what I promised to teach is there are 6 proven steps to becoming a millionaire apartment investor. Now, make it sound like easy, get rich quick. And it's not, it's just not. It takes time and energy and commitment. But so one is, and this is not in any particular like level of importance, but one is thinking differently. And I went through part of it is like when you learn to collaborate with other people and go out together and do stuff, we could do things together, Mauricio, better and bigger and more effectively than any of us can on our own. We got to learn how, money works. Like how do we generate money from multifamily and the tax savings and the cash flows and the upside, but also how to raise money. So there's a money component. So I call it the 6M framework. There's the mindset, the money, there's the markets, like how to select the right market and then not only select it, but dominate it, like become a true market wizard and know your market like better than your competition. And that's how you're going to dominate it. And so like I have speakers coming in that. So there's mindset, money, markets, and then marketing. How do we use language and stages to brand and market yourself more effectively to win more deals and raise more capital? And so we're going to be, talking about that. We're going to be talking about management. Like, it's not just closing the deal, but how do we effectively manage the asset, manage the investors, manage the management company, manage the rehab. So when I say management, I don't just mean property management. I mean management of the business. So, those are some of the things we're going to be talking about. And then like just the steps, like general steps, like how do certain business owners just, achieve a level of mastery? So that's the last M is mastery. And these are things that are not just related to multifamily, but like, things like focus, commitment, congruency, honoring and keeping your word, like showing up on time. Like a lot of these things don't cost any time or money. They're just like characteristics of like, if you study the most successful people, they have certain patterns and characteristics that are teachable that people could embrace themselves and be more successful.
I love it. It's all these M's, the multifamily, mindset, mechanics, money, marketing, mastery, all this stuff. I'm going to put the link in the chat for you guys if you want to check it out. Is that the best way for people to find out about it, Brad?
You just go to AIMNATCON.com. Let's see, does that AIMNATCON, which is Apartment Investor Mastery National Conference. Let me see what happens if I click that. Yes. That's funny. It says, if you are not interested in building wealth or making connections, please do not attend AIMNATCON.
A lot of people predicting the Fed's going to be lowering interest rates next. It's actually next week is their meeting. Are you in that camp? And what do you think that'll mean for apartments? Will it have any material change in the short term?
Well, look, it depends, so the answer to your question, yes, I believe the Fed will lower rates. I don't know if it's going to be 25 or 50 basis points. I think up until now, like the one thing we could count on, and the Fed has been a little I remember January 2024, the consensus amongst the experts was there are going to be 7 interest rate cuts this year. Do y'all remember that?
Yep.
And look, we got to be prepared either way. And that's what this conference is all about, is like, we got to be prepared for a Trump administration. We got to be prepared for a Harris administration. We got to be prepared for inflation to continue. We got to be prepared for inflation to stop. We got to be prepared for the Fed to cut rates. And what does that mean? Okay, the Fed cutting rates, that in itself is not going to save the industry. Okay, what's going to save the industry are the things that we're going to be teaching and talking about. It's going to be mastery. It's going to be commitment. It's going to be learning the ropes of the business. It's going to be, being resourceful. It's going to be having a strong team of advisors around you. Like this is what's going to accelerate you when times are good, and it's going to decrease your risk when times are tough.
I think you may have answered this already, but David asked, is the distress, maybe specifically talk about the distress in multifamily, is the distress peaking or is there more pain ahead? I know there's a lot of this extend and pretend stuff that's going on with the lenders. So all these bridge loans are coming due, and it seems like they're just keep kicking the can down the road. And I just want this thing to get over with, and let's move on to the next cycle. But do you have any insights on the distressed market, since you're probably one of those insiders that can buy some of the stuff?
Well, I mean, I think there's going to be some distress still. Like there are loans that are coming due, and here's what happens when a loan comes due. And I made a post on this on LinkedIn the other day. GPs need to be doing all of these at the same time in advance of the loan coming due. So let's say your loan's coming due in like 6 months from now or 5 months from now. Like you need to have brokers putting BOVs together, which is broker opinion of value. Like what can you get if you sold the deal? Because that's one way to exit the deal. And for a lot of people, it's going to be selling at a loss of capital. Now, is it 5% loss of capital or 100% loss of capital? And so that's an option that you need to consider. And then the next one would be, can we refinance the deal? And a lot of times, let's say you bought a property at 10 million, and you have a $7 million loan. And now because of where the cap rates are and where I think we are in the market cycle, maybe it's only worth 9 million today. And you can only get a $6 million loan. So if you refinance, you actually need to do a cash in refinance instead of a cash out refinance. And so that is a reality that a lot of GP teams and a lot of investor groups are faced with. Another one is extending the loan. So if you have a 3-year loan, you could have the option to extend it for another year, but you have to meet certain hurdles with the lender. And some of them are agreeable to negotiate those. Like I just did a loan extension, Mauricio, on like a $33 million loan on a 40-some million dollar asset. And they waived some of the provisions to do the extension. Why? Because we're paying all the bills. We're at 94% occupancy. They see we're hitting all of our income targets, but they also understand that like taxes and insurance went up in a way that nobody could have predicted. It's not just interest rates. So like they still see us as a desirable asset and they want to keep working with us. So like we got a 1-year extension. And so some people could say, oh yeah, you guys just kicked the can down the road. But it's like, look, the plan was to get a 3-year a 3-year loan and refinance or sell at a profit. And so now it's just 4 years. Like in 2008, I bought deals that I wanted to exit in 5 years. And some of them, it took me 7 or 8 because we went through a downturn. But like everything that comes down at some point in time will come up. Real estate and multifamily go up over the long term. And I know it sounds cliche, but I've been through the pattern. So like I'm less prone to panic when I see like a predictable market cycle.
Yeah, and I had James Eng, as you know, James, National Director of Old Capital, a couple of weeks ago, and he talked about how, if your loan is current, as long as you're, making your payments and things are good, they're saying about 95% of lenders want to just extend. And again, some people say kick the can down the road, but it's only when you stop making the payments to the bank that it becomes problematic, right?
Yeah. The worst thing you could do as a GP team is prioritize other obligations and miss the loan payment. Because now the lender's going to be like, okay, what's up here? And then you're going to be moved over from the servicing department to the special servicing department. And that actually doesn't give you more negotiation power. It actually gives you less.
And if you end up losing that property because of the loan, good luck getting another loan in the future, especially if it's agency, right?
Yeah.
Let's talk about some of the mistakes people make, Brad. Like what are you seeing as the sort of the biggest mistakes that in the apartment world, investors that come in?
Well, there's several, and I'll just say one of them, and this is no particular order, but like one that's very current is people look at the projections of the deal more than they look at like who's on the GP team and how are we going to handle adversity. And so if we learned anything through this last 18 to 24 months is going forward, even if times get better, like this business of syndicating apartments or syndicating anything for that matter, because Mauricio, you don't just work in multifamily, right? I mean, I know it's probably a big chunk of your business, but you're a syndication attorney and you probably help people with a lot of different types of syndications. And syndications involve the selection of people. So don't overlook that. So number one is the people on the team are just as important or more important than the physical building and the location. So that's number one. And then two is like, you know, we tend to look in a rear view mirror, and our memories tend to be like highly biased toward what the short term is. So like right now, people are cautious, people are afraid, people are standing on the sidelines. A lot of people have pencils down. I don't know anybody in 2009, 10, and 11 that said, man, I wish I would have bought less real estate. I don't know anybody like that. Like, I don't. And so like, some of you might be listening to me now thinking, man, this guy's full of shit. He doesn't know what he's going to talk about. I'm going to wait, and I don't want to catch a falling knife. But like, and I could be wrong, but there is a time where you just got to jump in and have confidence that like, hey, I've surrounded myself with a strong team of advisors and I've de-risked myself as much as I can. You can never do it completely. But I got a strong team of GPs that are liquid, and we're buying an asset in the path of growth. And we have a great management team, you know? And so like, look, sitting on the sidelines, there's a cost to that. Like, there is a cost to sitting on the sidelines. There's a cost of not taking action.
Yeah.
Okay?
Don't wait to buy real estate, right? Buy real estate and wait. Kind of butchered that, but don't wait to buy real estate. Buy real estate and wait. That's kind of.
I would say another one is trying to do everything on your own. Like, do you understand how much time and energy it takes to go out and buy 16 units and then manage it yourself? You know, talk about buying yourself a job.
Let's talk about that, Brad, because you talk a lot about that, where you don't think people should start off buying small, you know, like you said, 16-unit apartment building. You think it's easy to just get right into a 50 or 60-unit apartment building, right? Talk a little bit about that, because that's a different mindset too.
Well, again, provided that like the first step would need to be somebody that says, yeah, like if someone comes to me and says like, and I hear this, so like, this is not me, it's just like what I hear, man, I hate working with people. I don't trust anybody. You know, how do you trust other people? Well, it's like, look, here, let me just share something with you. We all trust other people. You trust other people that you never met before with your life. Each and every one of you right now trust people you never met before with your life. And I'm going to prove it to you. You get in your car and you drive down the highway, and the only thing separating you from a life-ending situation is a dotted or solid line on the road. You don't know these people coming your direction. They could be drunk, or more likely they are texting. But you get in every day and you trust complete strangers with your life, and you take that risk. But yet, you know, we don't trust other people doing in our business ventures. And that's okay. But like, learn, just like you look, there's a proven system to underwrite a deal, right? Like, things with numbers people could put their mind around. Like, we could learn how to underwrite a deal. Well, you know what? There is an effective way to vet people. And it's not to just show up to a meetup and exchange business cards. And that's what so many people do. It's to actually, like, when I go to conferences, I would rather walk away with 30 meaningful conversations than 300 business cards. You know, and people come to my event and they're like, well, how many people are going to be there? You know, I'm like, hey, yeah, we hope to have 400 or 500 people with this event. But instead of saying, hey, I want to walk away with 400 business cards, say, hey, I want to have like 30 meaningful conversations over the next 3 days. And then take those 30 to another level. Or consider like, and I know it sounds self-serving, Mauricio, but like, I put my money where my mouth is. Like, I'm in mastermind programs where I go away and I spend, you know, a lot of time with people before I become business partners with them. You know, and I don't want to equate it to marriage and dating, but like, how many of you would just, you know, how many of you would meet someone you know, that you want to have a lifelong relationship with, and you meet them one time and then you get married? But we do that in business. Hey, I met somebody and hey, we're going to form a website and start a company and do deals together. Like this is a 3 to 7 year marriage in business. You know, that could last longer than some marriages last. And so like make those decisions wisely and invest in your community, invest in your network. And it's not just business cards. Like it's having meaningful connections and conversations with people. And it's also, see, like, look, when you go to, like, Mauricio, you said before we got on here, you were going to pop into this meetup I did in California. You know, you could go to a meetup and connect with somebody for 2 or 3 hours and then get into a deal with them. But you don't, this person is on, man. Like, hey, when you go to a networking event, you're on, meaning you're on your best behavior, you know, you're on. You know, have you been able to observe somebody when things aren't going well? You know, and one of the things I'm most proud of is how my students have performed. Another one is like my partners, they tell me like, Brad, you're like a great partner. Like you don't, you know, you're not flying off the handle, that we haven't met our numbers. You know, you're calling us asking how you could contribute. Like we feel like you're a person that could be counted on, you know, whether it's with money, with time, like, let's get in alignment here. Like, let's make sure we're rowing in the same direction. Because one of the biggest reasons for failure in times of adversity is when the GP teams are not aligned and they're pointing fingers at each other and blaming each other for what's going on.
That was gold. Thank you. Rick was actually asking how to get a hold of you, which I haven't gotten to yet, but talk about your mentorship program too. Cause you've got this amazing, a lot of my clients are actually in your mentorship program. Talk about the power of the mentorship program and why somebody should consider joining.
Well, look, I don't know a better way to you know, look, here's an example. How many of you have heard of OPM, other people's money? Everybody knows the value of that. But we underestimate OPE, other people's experience, OPT, other people's time. And to me, that's a huge currency. It's like, you know, yeah, you could, like, everything that I could teach you or anybody could teach you, you could figure out on your own with enough time and enough money and enough effort. But like, for me, like, mentorship is the secret to my success. Meaning like, hey, if I invest 30K to, you know, hang around Tony Robbins for a year, which honestly, his is 85K. So you can't even do that for 30K. But like, if I could go to, you know, 5 conferences a year with Tony Robbins and then go to his house and it's 85K and I'm around other people that have also invested 85K, I know they're all committed and I know they all have money and I know they're all serious entrepreneurs, because if they weren't, they wouldn't have invested 85K or had the means to do so. And now those people become my network. It's like a self-filtering mechanism. And now I'm also like learning from all these people, like how are they able to afford this? Like, I know how I am, but like, what are they doing? And we're all learning and growing from each other. So like, I'm just telling you, man, it's just like anything you do, there's a saying that like mentorship takes decades of figuring out yourself and turns it into days. Turn decades into days. And that's what I do. That's what I do in my program. Like, you know, people will come to my event and they will learn from me for 3 days. But if they really want to have, you know, sustainable long-term results, like, I got a 1-year program for that, you know, and it's not cheap. And I don't mind telling people, like, I'll offer it at my 3-day event. Like, it's not a sales pitch. Like the whole event is full of content, but I'll probably spend an hour over a 3-day period talking about my 1-year program. And like, you know, I saw something on Bigger Pockets, like, hey, what's the difference between Sumrok's program and this other guy's? And they're like, well, the other guy doesn't sell anything. And I'm like, you got to be kidding. Like, it's my duty to help other people, you know, and I can only help people for so much in this. Like, let me just ask everybody on here, has this been valuable to anybody here? Like, is there valuable information here? Just give me a show of hands. Now, imagine the value in 3 days. Then imagine the value in a year. Like, I'd be doing, look, it's not for everybody and nobody has to buy my 1-year program, but like, I would be I would be selfish not to offer people an opportunity to work with me and my team for a year. And it doesn't mean that you need to buy it or that it's right for you, but there's a percentage of people that want it and need it and are happy that I'm doing it. Mauricio, I could have made so much more money. And I'm not going to mention off some of the names, but they're big name people in Dallas, and they all started in 08, 07, 06, 09, and, the big name people. And I'll mention some of them: Michael Becker, Charlie Young, Scott Everett, David Moore. All these people are friends of mine that have tens of thousands of units, and their bank accounts are bigger than mine. But I love doing what I'm doing. I love doing what I'm doing. And I love doing the deals, and I love having a system that helps other people do the deals.
Love it. And I'm going to echo Paula's comment here. Brad, this was pure gold, and really appreciate you taking the time out to add value to the real estate syndicated community. Again, put it in the chat. I always mispronounce this, but it's AIMNATCON, right? It's like a tongue twister.
I'm going to put it in here. So
AIMNATCON, AIMNATCON. You got like Tom, my good friend Tom Wheelwright's always there. One of my mentors, Robert Helms. You got a bunch of great speakers there. Take us home.
So
take us home with that.
I received a direct message from somebody, and I responded, and it just went to that individual. So I just did it to everybody. So AIM stands for Apartment Investor Mastery. NAT stands for National, and CON stands for Conference. So hence AIMNATCON. And what it is, again, it's a 3-day event. It's September 27 through 29. It's in Dallas, Texas, which is easy to get to. And I'll just say this, and the tickets are a couple $100, not a couple thousand. And there's going to be 9 speakers, including me, speakers on tax strategies, using speaking and languaging, wealth building strategies. Bill Walsh is a global entrepreneur and business coach. Lauren Lahav has worked with Tony Robbins for 31 years on mindset and goal setting. Tom Wheelwright is a tax reduction specialist. Neil Baugh was the mad scientist of multifamily. I mean, oh boy, I looked at Neil's presentation today as a draft, and that really has a lot of data about where we are, where he sees us in the market cycle. John Chang is the number 3 executive at the nation's largest commercial real estate firm, Marcus & Millichap. Like Charlie Young owns 20,000 units. Like every one of these speakers are friends of mine. None of them are being paid to be here. And each one of them in their 1-hour session will be worth a couple $100. Now imagine having all of that in a 3-day event, and imagine being able to network and hopefully having meaningful conversations with tens of people instead of getting business cards from hundreds. And I'm going to have like some industry experts there, like lenders and, cost segregation companies and people that want to be there, call it as an event sponsor, but people that want to have access to the people that are coming to the event.
David Priest says, AIMNATCON, be there or be square. If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.